Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I'm going to be the host for this podcast today. As I am, and I have been with you for almost 4 years now, and I took the last 30 days off. I wanted to spend some quality time with my daughters, with our daughters, and our grandson in South Florida, so we had a wonderful time, but I just couldn't get back to, re-engaging in the type of work that I do, and it's also tax season, so it's keeping me quite busy as well. We'll talk a little bit about that. But the title for this episode is Intelligence versus Wisdom. And there's a big difference between the two, and by the way, this is episode 171. So once again, thank you for giving me the loyalty, for being here every week as we normally are, except for the time that I just took off, to share ideas and to kind of learn from each other when it comes to financial matters, because there's a lot going on that we can talk about, and I'll continue to talk about over the next few weeks regarding all the potential tax changes and the impact that these changes will have on you, on your business, on your retirement account, and most important, on your family. One of the things that I say often, especially when I have discussions with clients and friends regarding intelligence and wisdom, is that you can have a master's degree and still be an idiot. And believe me, I have met many educated imbeciles in my lifetime. And I see them on the streets every single day. So you could have a master's degree and still be an idiot. And that's something that most of us have to live with. Now, one of the interesting things about being a tax planner, number one, it keeps my firm and I busy for the first 4 months of the year, and that's important. And then we do tax planning for the rest of the year along the way. But tax time reveals people's ignorance when it comes to financial matters. And I see it because when people send me all their documents for me to review and so forth, I get to see a lot of the mistakes before I even have to plug their numbers into my tax software in order to identify their liabilities and so forth. You can just see it. You can see it as soon as you get the W-2s and the 1099s and their expenses and their contributions to their qualified plans and their accounts and their retirement business and so forth. So I'll talk a little bit about that. And, the other point that I think is important for me to mention to all of you is that, you see, you don't pay a plumber to just bang on the pipes. You pay a plumber to know which pipes to bang on. And it's important because many of the clients that come to me to pick my brain, they're actually paying for my knowledge and my understanding and my many, many years of financial experience and having an accounting background and a financial background as well. So whenever I'm giving them a recommendation or whenever we're having a conversation, it's not just an assumption. Because I know what I'm talking about. So whenever I give a recommendation, not only do I give the recommendation, but I also provide the basis for the recommendations. So what mistakes am I seeing so far in this tax season as a tax planner? And this is primarily with the vast majority of my clients, is that, well, when it comes to tax planning, you're either at the table or you're on the menu, period. No ifs and no buts. So one of the first things that I've noticed in this tax season is that although I have been talking to my clients about this for many, many years, most of my clients are continuing to make maximum contributions to qualified plans, and they did so for the 2021 tax year. And that's a very big challenge that most Americans and most of my clients have not been able to appreciate or understand because everybody wants to get that benefit today. They want to get that reward today, and they're not thinking about tomorrow. They're definitely not thinking about the future from that perspective. So they're maxing out on their qualified plans. And that would include your 401ks, your IRAs, your pensions, your SEPs, any type of qualified plan that may be suitable for a business and so forth. The other thing that I've noticed is failure to understand the basis of taxation in the United States. And if there's something that I would recommend to each and every one of you is, pay attention to a lot of the tax information that I give you. I'm going to be doing now at the end of tax season in April, I am going to do a webinar where I'm going to cover all of the potential tax liabilities and how to remedy most of them from an economic standpoint. And I'll let you know because I'm going to be sending a link and an invite to this webinar that I'm going to be conducting. Failure to understand retirement income and retirement taxation. What do I mean by that? Because I get that question often. Bert, I know you're talking about, retirement taxation. What's the difference between that and regular taxation that I've been working with for so many years? If you happen to be an employee or whatever that may be, or a professional or a company or even a small business owner. Well, although I have preached tax-free retirement for the past 2 decades, I would argue that less than 10% of my client base has actually adhered to financially sound recommendations that I have made over the past 20 years. And the proof is actually in the pudding. And, I'm going to cover some of those things that you got to start thinking about. And if you're close to retirement and you're not thinking about these things, well, you're going to be paying the price. So the next question is, well, so what happens when you retire? Well, a number of things happen when you retire. And although some of them are very good, others are very challenging. And if you have not prepared for them, then chances are you're going to pay the piper and you're going to pay the price, for your entire lifetime, for many, many years to come at least. Now, one of the things that happens when you retire is that due to your lack of planning, most of your Social Security benefits are going to be taxable. And they're either going to be taxed, either 50% of those benefits are going to be taxed, or as high as 85% of those benefits are going to be taxed. It really depends where you fall in the retirement income spectrum from a taxable standpoint. So if you don't do proper planning, most of those Social Security benefits are going to be taxed anyways. Now your 401k distributions are going to be taxed. Your spouses, if you happen to be married, your spouse's 401k distributions are also going to be taxed. Your IRA distributions are also taxable. Your spouse's IRA distributions are taxable as well. Any mutual fund distributions that you get from one year to the next is also going to be added to the tax pool and it's going to be taxable. Something else happens. Well, your kids are out of the house, hopefully. But even if they're not out of the house, you're no longer going to have the exemption and or the credit for them. So that's going to reduce your safeguard, and therefore your tax liability is going to increase immediately. Your mortgage is either going to be paid off or close to being paid off. So if it's paid off, then you're not going to be able to take the mortgage deduction anymore when you file your taxes. And if it's close to being paid off, then most of the mortgage payments you're making toward the end of the mortgage period is going to be principal, and very few dollars are going to be interest, because on a 30-year mortgage or a 15-year mortgage, most of the interest is front loaded. So that means that toward the end of the mortgage, you're paying more into principal than interest. So even if you can get some deductions, the deductions are going to be much less than when you were paying the same mortgage 10, 15, 20 years ago. The other thing that happens is, obviously, because you're now retired, you're no longer making contributions to qualified plans. So you're not taking a deduction on those contributions. Now remember, you don't have to throw away the baby with the bathwater. So when I'm saying to a lot of my clients, and when I'm telling them that making contributions to retirement plans have some major drawbacks, it does not mean that you should not make contributions to your retirement plans. But you have to do proper calculations. You have to do proper tax planning in order to determine based on your goals, based on your objectives, based on your age, based on the amount of money that you can safely contribute to a retirement account, what percentage should go through pre-tax versus after-tax, because the formula will dictate where you're going to be in order for you to be able to minimize and or eliminate most of the tax liabilities you're going to have in retirement, including those Social Security benefits that you never thought you were going to pay taxes off. The other thing is, if you own the business, you no longer have Schedule C deductions to offset revenues. So if you own the business and then all of a sudden you retire and you either shut down the business or you're no longer in the business, then you're not going to be able to take those deductions on your Schedule C or on your 1120S or your 1120 or your 1065 as a partnership. You're not going to be able to do any of that. So that will automatically increase your potential tax liability. So that's important. And, finally, I think you're going to realize that your tax liabilities in retirement are higher than while you were working. Now, most everyone that I talk to, and most everyone that comes to see me for the first time, they have actually worked with other advisors in the past. And most of these advisors are telling these clients, well, max out on your 401ks and your IRAs, because when you retire, you're no longer going to be generating income. You're going to live off the income that you have saved. So therefore, you're going to be automatically in a lower tax bracket. But that's not what happens. That's only half of the story. See, one of the challenges that I get is when I talk about, hypotheticals, and I talk about, the road to retirement, think of it as climbing a mountain. So if you were climbing a mountain or you were preparing to climb a mountain and someone would say to you, hey, Joe, or Karen, what would be the goal of every single mountain climber? 99% of the American public and 99% of you and my listeners would say, well, Bert, the goal of a mountain climber is to get to the top of the mountain. And my answer is, well, that's only half of the goal. Because half of the goal is to get to the top of the mountain, and that's correct. But the other half of the goal is to make it back down the mountain and to make it safely. Because getting to the top of the mountain and then dying on the way down, as many times it happens on Mount Everest, it does you no good, because who cares if you made it to the top and never made it back down to the mountain. So when it comes to retirement planning and retirement distribution, you have to divide your retirement just like if you were climbing a mountain. As you were climbing that mountain, you were in the accumulation stage. So you're looking for tax-deferred growth. you're looking for good rates of returns, and you're looking for investment capability and consistency of investment and so forth. But once you reach the peak, which is once you reach your retirement years, then now you're going to be coming down on the other side of the mountain. And now you're going to be looking for safety. You're going to be looking for guaranteed income so you can never outlive your retirement assets. You're looking for being conservative on your retirement distributions. You're looking for either eliminating or reducing your tax liabilities, because the higher your tax liability in retirement, the more money you're going to have to take out of those retirement accounts in order to offset those increases. You're also going to be looking for lower inflation rates. And, obviously inflation in the U.S. is higher than it's been in the last 40 years. And it will more than likely continue to get worse, at least for a while. Well, what would happen if you're in retirement right now? And for those clients of mine that are in retirement, and now I'm doing their taxes for the year, they're telling me, Bert, I'm feeling the pain. But on top of that, we all know that taxes are going to be higher in the future than they are today. So if that is the case, why did you not do proper planning in order to identify how much money you could actually put into your retirement accounts, and then being able to take that money out without having a tax liability and without compromising the taxation of your Social Security benefits by doing proper planning? So those are the conversations that I have with my clients. Sadly enough, I would say that anywhere between 85 to 90% of the people I have talked to, and I have done dozens and dozens of webinars and seminars at colleges and universities, they listen, but they don't hear. They say, wow, that makes a lot of sense, but then they don't execute. It's just like people that know exactly what it takes to get in good shape. You have to have a good diet, you have to exercise, and you have to have consistency. Pretty simple. Yet 2/3 of the American population are fat. And why is that if it's so easy to get in shape? Because people are having a very, very difficult time putting a plan together and then following through it. And because of the fact that now, every single asset, every single distribution from each and every one of the assets that you have coming to you in retirement are fully taxable because you haven't done any proper planning. And now many of the exemptions, deductions, and credits that you were enjoying while you were working and raising a family are now pretty much gone. All of a sudden, your tax liability is much higher, even though your income may be lower than when you were working, because you cannot offset that income, that current retirement distribution income, by anything other than a prayer, and prayers are not going to get you anywhere. So at the end of the day, Houston, we have a problem. And what I do tell my clients, I had a conversation with one of them last week because their tax liability was about $7,200 higher than what they expected. And they couldn't conceive it. And when I walked them through, the contributions, and I always provide my clients a tax summary over the last 5 years, where they have been in the tax spectrum. They couldn't understand the impact of retirement, and they basically say, you know what, Bert, we listened to everything you talked about, for the last 5 or 6 years, because they've been clients of mine for that long. And we try to put some of it in place, but, getting that tax deduction every year, was so appealing to us that we refused to pay the tax then. And now we are sorry that we are in this position. And what can we do to remedy this issue for years down the line? And then obviously I can set something up for them, but that would be a different conversation because they are already in retirement. So, always remember that the road to hell is paved with a lot of good intentions. And I know that most of you mean well, and I know that most of you want to do the very best for yourselves, for your family, and for your business. But at the end of the day, if you don't pay attention, if you don't talk to people that understand taxation and the impact of taxation on your retirement distribution planning upon executing that retirement goal and objective, can actually create havoc for you and your family. And because of the increase in taxation now and the increase of taxation in the future, there's probably a very high probability that you're going to run out of money before you run out of life. And that would be a really, really sad thing to find yourself in at that point in time. So for those of you, and again, thank you for being part of this podcast. But for those of you that may want to reach out to me, please shoot me an email. You can send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And you can also call me at area code 786-766-1042. You can also reach out to me at my cell phone, 305-304-4770. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks for giving me a few minutes of your time, and I'll talk to you again next week. Take care. Bye-bye.